We are going to walk through this process, but first a couple of disclosures. This presentation is the third part of a 3-video series designed to help you and your financial advisor create a tax-efficient retirement strategy. In this section, you will learn strategies to reduce your lifetime tax bill. We'll pick up where we left off with interactions between different income types.
So let's get into a case study and talk about the variety of different things that you can do. So John and Jane are married filing jointly, and they're both over 65. They have $60,000 of combined Social Security benefits, $10,000 of net long-term capital gains, and $52,000 that's coming out of their IRAs. This is their actual experience. The gray is what you might call an effective marginal rate. In other words, how much do I actually lose to federal income tax on the next dollar I take from an IRA? So in this particular case, as we move right, we see that this couple can take just over $10,000 out of an IRA before they start experiencing an 18.5% effective marginal rate. Then they jump up into a 22.2% effective marginal rate before finally landing in a 49.95% effective marginal rate. And you may say, those don't line up at all with our 10% bracket, 12% bracket, 22% bracket. And that's exactly the point. It's the interactions between different income types that can really throw a wrench in retirement income plans. So how did that 49.95% happen? If we trace that 49.95% down, what we'd notice is that these clients are actually falling in the 12% bracket, and yet they're actually losing 49.95 cents on the dollar for every dollar they withdraw in this range from an IRA. And you might say, how can that happen? The reason is because we need to be paying attention to the interactions between different income types. So intuitively, we would expect that $1,000 IRA withdrawal would trigger $120 of federal income tax. That's 1,000 times a 12% bracket. But what happens in reality is that $1,000 IRA withdrawal does trigger $120 of federal income tax in the 12% bracket. But it also causes $850 of Social Security to become taxable that would have otherwise come through tax-free. That gets taxed also at a 12% bracket, creating $102 of additional federal income tax. Finally, that additional $1,850 pushes $1,850 of capital gains out of a 0% capital gains bracket and into a 15% bracket, creating $277.50 of additional federal income tax. So the total additional tax burden on that $1,000 withdrawal was almost $500, even though the client fell into the 12% bracket. Now, a similar situation can arise with capital gains. And in this particular situation, we would see that there's a 38% effective marginal rate. So if I were deciding whether I were going to sell the entirety of a position this year, I might say, no, I really only want to sell $14,000, $15,000 of capital gains because I don't want to experience this 38% effective marginal rate. One of the most common challenges we see among people who meet with us for the first time is that they've done an incredible job of saving into 401k and IRA plans. And maybe they've had some great experience with the markets. When we project out their income need to live the lifestyle that they want throughout retirement, and we also project out what their required minimum distributions will be in the future out at age 72, we often find that they will have more money coming into the household than they actually need to live the lifestyle that they want to live. If you're in that situation, though, there are often opportunities to balance the taxes you pay today with the taxes that you pay tomorrow in order to create a lower overall lifetime tax bill. In this case, we see that these clients are not paying anything at all in federal income tax for the first several years of retirement. But once they hit age 72, the green over the blue means they have more money coming into the household than they actually need. And the red, you notice that is the federal income tax. That's really taking up a significant portion. And remember that each additional dollar that comes into the household is taxed at your highest marginal rate. What that means is that if we are able to balance some of those taxes earlier in retirement, we can create lower taxes later in retirement and oftentimes reduce your overall lifetime tax burden. Now, there are a variety of possible ways to do that. You can spend from IRA money first. Most people will spend other assets and save IRA money for as long as possible. You could change when you collect Social Security. As the foundation of retirement income, there are often a lot of benefits associated with making changes around how and when you collect benefits. You can do Roth conversions, pushing money from a traditional IRA into a Roth IRA. Now, you'll pay taxes on the amount of that conversion, so you generally don't want to convert entire accounts at once. But strategically identifying how much to convert can add terrific value over a lifetime. Finally, you can harvest capital gains, taking advantage of a 0% tax bracket, or sometimes harvesting capital losses may make more sense in order to offset capital gains. Again, there are a variety of possible solutions, and which makes sense for you will depend entirely on your personal circumstances. But the guide for those decisions is the tax map. Understanding how much we're likely to lose on the next dollar we take action on. If we take more money out, are we likely to hit a spike or an unusual interaction with other income sources? Or if we take less money out, can we avoid one of those ugly situations? Ultimately, our goal is to get you the spendable income you need with the right balance of different income types to minimize taxes. Following this process year in and year out through retirement will help you minimize taxes through your lifetime, leaving more money for you to do the things you enjoy.